Those closest to the money spigot have increased their power. The banking system and the government and those that are attached to those apparatuses are increasing the amount of inequality. They're able to create credit instruments that allow them to buy up more and more and more of the resources. People have to find a way to combat that. So that's where Bitcoin comes in.
Welcome to Who Knows. I'm joined today by Nik Bhatia. Nik's a professor at USC, the founder of the Bitcoin Layer, and author of two great books, Layered Money and Bitcoin Age. Nik, thanks for being here today.
Thank you, Henry. I appreciate you having me on.
We were just talking before, but I'd love to interview you mainly about the history of banking. I think you lay it out so clearly, and for people like me that don't have a finance background, so in such a digestible way. But also, I've been paying attention to your work the last few days here this week on what the heck's going on with the Federal Reserve, with SOFR, all these repo, all these acronyms. I don't know what they mean. So, could you shed some light on what's happening right now?
Yeah, absolutely. People are more familiar with stock markets or bond markets, for example. So let's take the stock market to start. Stock market is equity in companies, and it's highly liquid, but that doesn't mean that these assets are money-like in any way. They're investments, right? They're shares in a company that have cash flow. So assets like land or like equity, assets are different than money. And people need money to transact and basically to transact, whether it's to consume or to buy assets. You need money to do that today in today's world. The assets are what people strive to have with any excess money, because today the money doesn't hold value, right? It decays, and that's a natural decay through our credit system. But that natural decay basically tries to, it influences people and actors to buy investments or assets with any excess money. So that's where we'll start. Within money, there are many types of money. There are treasuries, which are more assets than they are money, but the shorter the asset, the shorter the treasury asset, the more like money it is. Nevertheless, you still cannot spend a T-bill. You have to sell it for money and then buy something else. So treasuries still are assets, not money. Then within money, you have what I would call, and I won't use inside and outside money. That's a different, because that's more of an official definition. If people want that, they can go to the Zoltan Posar money matrix and go to inside and outside money. But just for this example, let's say that there are types of money. There's fringe money, and then there's core money. Fringe money is like deposits. So from a layered money perspective, that would be like third layer money, deposits issued by banks, commercial banks, private banks. Core money would be that second layer money, which is Federal Reserve liabilities that they issue to the banks. So the banks issue money to you, and the Fed issues money to the banks. The money that's issued to the banks, that core money, that has a limited quantity. There's a limited amount of that core money. The fringe money, the deposits of the world, and private money doesn't have a limit. It has a quantity that you can, I guess, let's say you can measure it, but there's no theoretical limit to how much that can grow. Now, the core money, the limit to how much it can grow is held by basically one institution, that's the United States, acting through the Federal Reserve and to a larger and larger degree the Treasury Department. But it's the US that is in control of core money, but the banks, the private sector, and frankly, the international banking system through the Eurodollar system are those that are in control of fringe money, meaning that there's no limit because there's no agreement between those banks on what to do with the quantity. Now to today, what's happening? The quantity of core money is proving to not be enough for the global economy and the quantity of fringe money, let's just say. So the quantity of third layer money is outstripping what the current quantity of layer 2 money can provide to the system, because you need it to facilitate interbank transfers and transfers between the banking system and the Treasury Department, which happens through the issuance of Treasury bills and Treasury securities. So the shortest answer I can give you is that the quantity of T-bills has gone up too much, as well as just the economy itself has grown too much, that the core amount, meaning the reserves in the system issued by the Fed to the banking system, is proving to be too scarce to continue for the plumbing to work well. And that's evidenced by higher repo rates, which just means that there's a tightness of how much cash is being used to finance this treasury issuance apparatus that's going on. So I hope that I gave the long answer and the short answer there.
So let me ask one follow-up there. You said in your most recent podcast, I think it was today or yesterday, there are maybe not alarm bells fully going off, but the light has been turned on. They're starting. What is the Federal Reserve then trying to do right now, or what are they trying to accomplish if these problems are starting to arise?
What they have to do first is stop the quantity of reserves from falling, which they have been doing for the last couple years, and they avoided, this is a little technical, but they avoided a lot of that reserve rundown with this reverse repo facility that they offered to the market. But that's gone because there's just no excess anymore. That was the excess. Now the reserve amount is declining. A little bit is responding to the Treasury Department funding its account and not being able to spend down some of the money right now. But the main point is that the Fed has been in QT, which means shrinking reserves, or the policy to shrink its balance sheet, which didn't impact reserves that much until the last couple months, where now it has started to impact. They know they have to stop that.
Yep.
Ignoring everything else, the economy is growing too much for that. And the repo rate tells you that there's an imbalance. There's a scarcity there. So they have to stop, which they announced in their October Fed meeting. They said, we will stop. November 30th will be our last runoff. And then after that, we'll keep it flat. The next thing they have to do is then announce, this is how we're going to gradually grow it. And they're doing it slowly and through very coded language so that the market understands that this is not an emergency response, but rather good monetary policy. So that's framing. We can, we can pick that apart all we wanted, and people do. But the main point here is that they can't allow reserves to shrink anymore. They're going to stop that policy here in a couple of weeks. They've announced that. And then the next announcement will be, okay, we're going to have to grow them, and at what pace. But we might see the repo market force their hand to do it sooner, or we might not. So the government shutdown ends and government can spend TGA. What happens as soon as that happens? TGA, which is the Treasury's account at the Fed, goes down, government spending. And where does it go to? It goes into reserves because it goes into the banking system. So it's actually a zero-sum game between the Treasury's account and the quantity of reserves. One goes down, the other mathematically goes up because the Fed is not involved in money creation or destruction there. That's just the government spending money into the private sector. You see, they both bank at the Fed, but the Fed isn't controlling any quantity adjustment there. It's just a debit and a credit on its balance sheet. So from that perspective, government shutdown ends, boom, reserves will pump. They'll do a mini pump. Then all the repo trouble might go away for a couple months. Then the Fed doesn't have to do anything to increase the quantity on the aggregate. Right? The Fed doesn't have to be an actor. The government just spends it down and it solves the repo problem for a couple months.
Yeah.
So the Fed really does have to watch, and they do. We know this from the inside conversations we've had, and also from my own trading experience, conversations with the street. The Fed watches every repo transaction, every single one. And if there are tails, meaning if there are outliers to where they want the rate to be, they know in that moment and at all times they are watching. So we know what type of mistakes they've made in the past, and we do believe the Fed has learned from some of them and has adjusted policy.
You think the mistakes are mostly around timing, when to act, or?
So Henry, we only have one example. That's what makes this interesting. We've only had one example of quantitative tightening because pre-2008,
Wow.
reserve quantities, meaning QE, was not a United States central bank policy at all. So that's a new phenomenon. Then we only had QE. So we only had one example of QT, and that was in the 2018 to 2019 timeframe.
Yeah.
So that ended with the repo crisis in September of 2019 abruptly, and they made a huge mistake about not getting in front of that. Well, whatever they did wrong, they're learning from now. So they did QT then, they blew it. They're doing QT now. Their goal is to not blow it. So when repo rates wake up, as they have the last few weeks, and honestly, the last couple months, they've been showing signs. The Fed is watching that. They already, Henry, they already slowed QT, and I wish I remembered the meeting that they made that announcement, but I think it was May or June. I really wish I remembered that, but they already slowed it once.
Yeah.
And so that's your evidence that they're trying to learn from their mistake. So
Gotcha.
they already slowed it. And then they announce the end, and then they'll announce the beginning. And so you can see them steering clear of a full-blown repo crisis. And that's what I've been trying to say, is that the lights are flashing, but the Fed has been watching it this time.
Yep.
Whereas last time, they did miss it, and they did miss some aspects like the basis trade and how big it had gotten. But this time they're looking at SOFR balances, meaning how many people are using repo into what quantities. It's above 3 trillion every night. They know they're up against it.
Yeah. So,
and the street, one more last thing.
Yeah.
The street is also ahead of it. So like the street learns quickly, and the Fed and and Wall Street are kind of like one, because the New York Fed is the street to a lot of degree. Like it faces the primary dealers. So the primary dealers face the New York Fed, and that relationship is the core of the money market. So the street knows now what mistake that it made by not being on top of this also. So the street wasn't going to let the Fed get away with anything this time, and that's why we got an early end to QT, or the original slowing to QT, which happened earlier this year.
Gotcha. So this banking system is all pretty complex. We're pretty far upfield from where banking started, but I think you explain so well in your books, the story of how money came about and how banking came about. So I'd love to hear you share some thoughts on that. So why don't we start with, I think money emerging is one thing, and then I think banking emerging is a secondary thing. Why don't we start with the banking thing? What are the origins of banking going way back here?
Absolutely. And just to be thorough, Henry, in April, the Fed reduced the runoff from 25 to 5 billion a month. That's a huge reduction. That's an 80% reduction.
Yeah.
20 on 25. So that's 7 months ago.
Yeah, that's crazy.
So that's what I mean by the Fed is clearly trying to avoid the mistake it made in 2018 and 2019.
Yep. Gotcha.
So banking, where does it start? Well, I think the way to understand the introduction of double entry accounting to European finance, the way to understand that is with the original concept of tally sticks, or debt as money, meaning that money is simply what you pencil in for the value you provide to each other. So I'm a farmer, you're the merchant. I grow the corn and I hand you the corn. You don't give me anything, but I mark it down. And let's say we call it 100 coins, that quantity. Doesn't matter if it's a gold coin, a Bitcoin, a fake coin, a shell. It doesn't actually matter. You just write down 100, and I write down 100. But it's on different sides of our tally stick. It's an asset to me, and it's a liability to you. And when we put our tally sticks next to each other, you can see that it offsets. So that the tally stick is like banking, and the money is just what's maybe written on it. Now, commodity money is a separate thing. We'll talk about that because that's also important. But banking is double entry accounting. How did double entry accounting go from tally sticks to European financial system, basically these banking families? It traveled through, first of all, the idea of debt being money, or money just being a reciprocal favor. I owe you one. The fact that it's an IOU means that the concept of IOU is anthropological, and that's important. It's anthropological for you and I to enter a deal that doesn't need any instant settlement or even a money, because I can do you a favor and then tomorrow you can do me a favor. Like, I take your trash bins out and next week you'll take my trash bins out. We don't really even need to write it down, let alone I give you $5 and you give me $5 the next week. I mean, that would be ridiculous for two neighbors to do. So that's why I start there, because money can be that.
Yeah.
Gold as money is a separate anthropological phenomenon, and that's also real. But you asked me to start with banking, so we'll do the garbage can analogy to start there. Now, double entry accounting was a Hindu Arab mathematical concept. And I say Hindu Arab because Hindu Arab, the numerical system that we use today, 0, 1, 2, 3, 4, 5, written out as individual, was different than the Roman numeral system that Europe was using for 1,000 years. So the numerical system was a Hindu system, and the accounting system of double entry bookkeeping what came from northern Africa. So when Fibonacci was in northern Africa, he learned these techniques and came back and wrote about the Hindu Arab numerical system and accounting system and introduced it to Europe. So it revolutionized banking through math first. Like it's a joint math banking revolution in Europe that Fibonacci brought back. And then that grew through Italian banking families. There was a Medici way, there was a Venetian way of accounting, and this brought debt as money into the forefront because within a few centuries, the double entry bookkeeping, I owe you, you owe me, tally sticks now brought onto basically, notebooks and ledgers. The notebook ledger entries then became pieces of paper that were sold as monetary instruments, and gold and silver coins were exchanged for the pieces of paper that represented the bookkeeping entries. That's what happened in Antwerp in the 15th century. That's what led to the Dutch inventing central banking as a derivative off of this idea that that debt instruments, debt entries could be transformed into money. And that sets the stage for our banking system today, which at one point the piece of paper was a promise to pay gold or silver, but it stopped being that. And the system functioned without a lot of exchange of paper for metal, paper for metal. It mostly became paper for paper over the years. So in 1971, the official break, and which started in the 30s with 1931, the Bank of England going off the gold standard, that process was, again, going back to anthropology, easier for the world to adjust to because it had been dealing in a paper for paper world, arguably for centuries, since the Bank of Amsterdam in 1609 introduced the idea that all the metal can stay in one vault and we never even have to see it, and we can still finance a global empire.
Wow. So going back to your original, really simple example, we're neighbors and I take out your trash can, you take out my trash can. Debt, or essentially bridges the gap in the timeline where we just record that or know it so that we can do it on different timelines and not both do it right then, because then there's no value to that. And then expanding on that, it's basically eventually I could sell that you owe me one trash can removal, and it has some value that some other neighbor might find valuable in the future, right?
Absolutely. You sell it for $4. You knew it was kind of worth $5.
Yeah.
And you don't know if I'm going to do it, for the other neighbor. So you discount it a little bit. The neighbor's like, okay, I'll pick it up because I could pay the market $5 for this, but I'll buy it for $4. So it's a great analogy.
So, and then obviously you mentioned gold. So maybe I asked the questions in the reverse order here, but how does gold fit in to this whole story, and when does that start becoming part of the banking system, and when does it break?
I'm smiling because even even 2 years ago, I would have said, yeah, you should have started with gold. But I think you started at the right place because
Hmm.
you and I exchanging, you know, a little bit of housework, trash bin, business is way more human
Hmm.
than us liking gold as a shiny metal, I think, because
Okay.
there's way more utility in, hey, I need sugar or I need flour from my neighbor, like
Yep.
to sustain my life, right? Food exchange is really the original human need. And so I think you started in the right place. And the
Hmm.
reason I say only in the last couple of years, because when I started on assignment to teach younger students than I was used to teaching, you have to bring it back and think about where do I start? Where do
Yeah.
I start? And I started with vampire bats, trading food with their family and non-family members in caves, and used the Nick Sabo shelling out paper
Hmm.
and that section about vampire bats, and I started there because that is more like banking than gold. So the question about gold is properly second, which is that over thousands of years of you and I hunting on alternate days, we both found this pretty metal that started to be mined and somewhat uniform. And the original wasn't even uniform, like a little pebble for me and a little pebble for you, but it was gold, and we had ways to test it even thousands of years ago that yes, this is real gold. We didn't know the periodic table of elements 5,000 years ago, yet we understood that gold was unique back then,
Yep.
from a chemical perspective. And so after thousands of years of you and I hunting on alternate days,
Yep.
the human race found gold to be a really good way to value that favor, so that we could sell it, we could trade off, and we could all specialize more than maybe I'm not a good hunter and I should be hunting on zero of the days, but I should be doing something else. You should be hunting on most of the days, but then I'll find my own specialty.
Yep.
And that's how economies develop, and even the concept of a city revolutionized that specialization even more, and arguably displace the need for gold as money, because then you have gold is really great between two tribes that don't trust each other. You and I could
Hmm.
still continue to hunt on alternate days because we know that we're always going to come through for each other at the end of the day because we have that relationship. But gold is great if you and I don't know each other. Hey, you hunted today? Well, instead of I'll hunt for you tomorrow, you're just like, well, pay me gold today. And I say,
Yep.
okay. And then you're happy. And I'm happy because I have food. So gold allows that trustless money. And that's why gold flourished. And to the same extent, silver, because you can't forget that both of these metals had a very large role in international trustless money
Yep.
over the years. Gold just mostly won out uh, over the last 300 years or so. But m- gold is really important because it took it it was the first universal money.
Yep.
And money is a very important technology, making gold, you know, a central fixture in our history.
Yeah, and there's also simple things around gold, right? Like, I mean, it could be money could be leaves from a tree, like an obscure tree, because there's only a few of the trees in town, but then the leaves rot, and gold doesn't rot, right? And you generally know in 3 years, if you're going to hold the gold, there's probably about the same amount of gold as there was 3 years ago. Unlike a tree, you go plant the tree, and now there's 3 times as much money as before, right? So people kind of slowly figured out those properties over time and kind of coalesced on that one to be the best one, right?
Yes, the durability and so many more characteristics make gold unique, right? There's a copper copper rusts, and
Yep.
even silver tarnishes, um, and oxidizes, I should say. And uh, gold doesn't oxidize; it doesn't rust. And even comparing gold and silver from that perspective is quite relevant.
Yep.
So but yes, there are more qualities, and some of them can't even be quantified. So they're metaphysical in nature, that the humans are just drawn to gold, and I think that matters. And people say,
Yep.
how do you quantify that? Well, the price is how you quantify it.
Yep. Well, so I guess, most people have heard of the gold standard. And like you said, Bank of England went off the gold standard in 1931 and the US in 1971. So, and, that was kind of the previous system of money was the gold standard. I mean, how did gold work at the center of like that monetary sort of banking system? And then why does everyone break and get off of it eventually?
Yes, it comes down to that core versus fringe money concept. The core money is the gold. If the fringe money grows too large, it the you can't print more gold, like the Fed will be creating more reserves to buy T-bills next year in 2026. You can't print more gold, you can only mine it. And so it ends up being a restrictive condition on governments. And part of the evolution of my own research has to confront the idea that a goldless system is better for people because their path isn't tied to an arbitrary amount of metal. The other side of that argument, then it means they're tied to policymakers and corrupt politicians.
Yeah.
So, but maturation means understanding both sides of the argument to the best of your ability. So the argument against a gold standard, and I would say that even the gold standard in the United States ended with Executive Order 6102 in 1933, and the
Hmm.
exchangeability from a foreign perspective ended in 71. So, really in the 30s, we went off a gold standard. That the reason that we went off a gold standard was because the gold standard caused the Great Depression. That's the mainstream narrative, that the quantity of gold was too restrictive so that the US policymakers weren't able to avoid a Great Depression. That has as much validity as today the fact that we don't have a gold system has caused incredible amounts of wealth inequality.
Hmm.
Both can be true.
Yeah. Interesting. I mean, I think Lynn Alden said it, I think, in her book and talks about it. She says basically gold broke when, as the core system of money, when the telegraph was invented. Um, Essentially, like in 40s or 50s or something, because um, gold used to be able to match the speed of the delivery of the service or the product, right? They both moved at like physically. And then once there was a way to provide consulting to Europe from the United States, well, now you can't get the gold there fast enough. So it was the first mismatch of settlement, right? And I had never heard it that way. That basically a property of gold failed at that point because it no longer matched the settlement speed.
I wholly agree, and it impacted my second book, Bitcoin Age,
Mm-hmm.
and I had a whole section about the telegraph and
Yeah,
how I believe that it did change the course of money technology. Yes, absolutely.
it's crazy. So why don't we then talk? It's basically two more big questions to me would be, and there's obviously way more to this story, but um, where we are in modern times. So that could be post 1971 or maybe accelerating post 2008 or both of those. That would kind of be one. And then where Bitcoin fits into this now and in the future. So why don't we start with like how are things working now since going off the gold standard, I guess is the question.
Those closest to the money spigot have increased their power,
Yep.
and that's where we are. So the banking system and the government and those that are attached to those apparatuses are are increasing the amount of inequality in the system, in that they're able to create credit instruments that allow them to buy up more and more and more of the resources, and therefore capital.
Yep.
So that's where we are. It it leaves us in a place where, you know, people have to find a way to combat that. So that's where Bitcoin comes in, is that it enables you to actively measure the dilution of the system and the amount of credit that's doled out to those that are inside the circle. And we also have to think about, something that I think about is, how do we correct the system so that it's less like this, tied to these two giant systems, the banking system and the US government,
Mhm.
and enriches those closest to it. How do we combat that? So, not that I have a great answer, but I think that those are some of the pressing issues. And that's why Bitcoin is so important to our species, because it offers us a starting place for those conversations for the first time since forever, because you can go back to the telegraph and say, well, if we had Bitcoin, then the telegraph wouldn't have obsoleted gold, because Bitcoin can keep up because it's a technology. It's a bunch of make believe scenarios. Basically,
Mhm.
we've been living, one way, and people did mostly have gold as a stabilizing force. And we have the period between 1870 and 1900 to even the 1920s to observe some of the benefits to a gold standard and stable money and labor being valued appropriately. Labor labor has been bastardized by the system,
Mhm.
by the credit system, because the value of your labor, you're being given money for it, but the money is a piece of crap, and your ability to turn it into something that actually allows you to outpace, before Bitcoin is very limited.
Yeah.
or you're forced into risk. So Bitcoin is very, very powerful concept and once in a species event. It doesn't mean it has to be even the money forever, but for the foreseeable future, for the coming decades, it can be a correcting mechanism for the world, and then it can hopefully and maybe eventually reverse back some of that wealth concentration within the banking and government system. That's more a dream than a speculation, though.
So if that plays out, you basically in layered money, you know, kind of say how gold was the core of the financial system, and then it was U.S. Treasuries in the last 50-ish years, and then we can go to Bitcoin. How does that actually happen? If Bitcoin, if we talk in 30 to 50 years, and Bitcoin is the core of a new financial system, how does it get there? What's its pathway?
It has to be the settlement currency for international trade.
Mm-hmm.
And I believe there's a path to that Bitcoin can be used to settle debts between governments, international corporations, the purchase of land territories from one country to the other. Then it becomes a truly neutral reserve, and im- it becomes that as an emergent process where it's never assigned, but the first time that one country sends another country, $300 billion worth of Bitcoin, and it goes from one wallet to the other, and it's not really swapped at any Wall Street desk or City of London, but done in an on-chain transaction between the two nations. That can only happen through an emergent process. You can't make the world get there, but I see a path to that. It doesn't
Yeah,
even mean
and
that government currencies are exchangeable for Bitcoin um, explicitly, but it would imply that governments own it as an
mm-hmm.
asset on their balance
Yep.
sheet.
Yeah, I mean, you talked about, so you wrote it in 5 years ago and published it in 2021, right?
Yes,
And the view on Bitcoin by all the banks when you wrote that was it's garbage. And then you also wrote how stable coins will be maybe the transaction layer in this new system. And so in the 4 years since you've written the book, I mean, stable coins have been put into the financial system this year, right? Number one, and then number two, even more recently, was J.P. Morgan within the last few weeks saying we will let institutional clients of ours borrow against their Bitcoin. So there's already two signs of it moving that way. Did you take those as big signposts toward it moving, or how did you interpret those pieces of
absolutely,
news?
absolutely. The legislation this year from the U.S. government, which was building up for a couple years,
Mm-hmm.
and the J.P. Morgan announcement of Bitcoin as collateral are massive signposts. And yes, we do live in a digital layered money system, and we continue to see that unfold.
Interesting. Um, there's a ton to talk about, but what do you think we missed today? That part of the story that might be important.
Maybe the United States' role in all this, because we talk about the United States government debt, we talk about the fact that that treasuries are the current world reserve asset that are
Mm-hmm.
looking to be replaced. So what is the US role in all of this? I believe it's healthier for the US to be less reliant on foreign entities owning so much of your debt, so you're beholden to them, So it's in the US best interest to reduce that quantity. Of course, as a percentage of global assets or of GDP. And so the US must and has already started embrace a very pro Bitcoin policy to drive the next global reserve neutral asset up to the top because it de-risks the US. And then I think about the Wall Street, which is they're short in a trade, they realize it's going the other way. Not only do they cover their short, but they go long. So to make money going back the other way. So the US has to do pro Bitcoin policy, but then double down on Bitcoin by buying it and by making sure that companies that are domiciled in the United States can buy it, own it, are trading it, and that people that own it come here and that it's within United States property law, because all of that then strengthens the country as Bitcoin rises as a technology. The stablecoin phenomenon is really just a bridge from old school banking to new banking, which is then modeled after Bitcoin. That's the whole point about stablecoins. It's dollars modeled off of how Bitcoin works.
Yeah.
So it works better. So therefore, it's a good technology. It boosts the demand for treasury bills, which helps the U.S. government strategically. But what's most important is it prepares the world for the digital currency system, of which Bitcoin is the neutral reserve. So all of it is really playing out ahead of schedule because of the new U.S. policy as of 2025 to both Bitcoin and stablecoins.
Yep. Wow. So Nick, I really appreciate you taking the time to talk with me today. It was great meeting you. Your books made a big impact on how I think about everything. So I really appreciate it. I'm gonna link to your books, the Bitcoin Layer, your Twitter account, anywhere else you want people to go to keep up with your work.
No, at thebitcoinlayer.com, there's links to everything. The books, the show, which is available, of course, on YouTube, which I recommend people watch because you get the charts. But if you're, a gym or driving podcast person, then the audio works just fine. But then, of course, we have our research publication for people that want the next level of quantitative research. All of that is available at thebitcoinlayer.com.
Awesome. Thanks a lot, Nick. Have a great afternoon.
Thanks, Henry.